Uh, the topic is chosen because we have come across a lot of our clients and people that we talk to every day. There seems to be a bit of a fear in their mind of exactly what to do next. Should we be buying this property now? Should we hold? Should we wait for the interest rates to come down? Is this a good time to buy? Properties that I bought a couple of years ago, should I sell them because they've gone up too much? Are they going to come down now? So these are just some of the questions that we are dealing with it day in and day out. So I thought that it is a good time from a timing perspective to try sort of run a macro view of where the markets are, the property, what exactly do we see as buyers agents in this market, and where are we heading to in the next few months, so that people can make a good decision around what they need to do with the circumstances. Now, of course, individually circumstances will look very different. So this is very general today that what we are discussing, and it's a view based on certain data that we have at hand, and we've tried to analyze that to see how we could use that for the purpose of trying to share this with our viewers, where property is sitting today and beyond. So with no delay, I think we'll get started. I'll move on. So we've got a few people already dialing in. So maybe another minute or so before those who have saved registrations, they should be there. And we've now gone live as well on a Facebook group on I Love Property. So that's great to see. If you've got any questions along the way, please do post them along the way on the side, and then we'll try answer them towards the end of this session, which is probably going to take about half an hour to 40 minutes. And then we can get into all your questions as well and try answer them for you. So we'll probably give another 30 seconds and then get started. Just want to make sure people don't miss out on things, because I rather focus on trying answering questions as I see them, and see how people are responding to that. Okay, so we'll get started now. So the first thing is it's a legal disclaimer. So the information that we're presenting today is absolutely general nature. It is strongly advised to seek your own independent legal, financial, and investment advice. We give no warranty and nor accept any liability for any decisions that you are going to make based on the information presented today. Now, if you were to see that there's any concerns from what you are hearing today, or you're concerned about your personal situation, we can always have a separate conversation with you as well. So even with the questions, as much as I like to try answer them at personal level on a forum like this, we rather have one-to-one conversation around that. So take this in the context of the information presented, and then we can take it from there. So welcome everyone. Those who have just joined, we've got about a good sizable people who have joined us today. So that's great. And we are also live on I Love Property group as well. So just a bit of a background. We are a buyer agency, an independent buyer agency. We buy properties all over Australia, but more than property, it's all about trying to get the financial freedom for our clients and actually making things work for our clients, getting the right outcomes for them. And we want to be, partnering with our clients in the journey to make things happen for them. So it's actually bigger than just property conversation for our clients. It's about holding the hand and actually trying to build the confidence around the investments and ensuring that we can actually take them from, maybe from nothing to everything, or if they have properties, assess it, see where we go, and maybe repurpose some of the properties that we have to make sure that you have the right portfolio and it's growing both in residential and commercial sector. So as part of the whole agency, we are about 15 of us at the moment, spread across the country, and we've served clients now for nearly close to 6 years and growing. So we've got offices in Point Cook. We are Melbourne based. I started the business back in 2019, and with that we've grown. 80% of my team are actually my clients first, and now we are serving others with passion. And at the same time, because we are spread across the country, we are able to deep dive into different markets and bring a real outcome for our clients at the same time. Now, serving over 600 plus clients, we have maturity that we've seen across different age groups from 17 all the way up to 71 that we deal with. And as a result of that, the depth of data that we have in terms of what the clients want, with both seasoned investors, developers, first-time investors, even for that matter, home buyers that we have helped buy properties for them to secure their own homes, has been an incredible journey, and we continue to do so with passion. What we do really matters because we're trying to make things easier for people. We're trying to get them from point A to point B with us being the support all the way through. And we want to make sure that people feel that it's part of the experience that we have, that we are building a partnership to try sort of get to the right outcomes and the relationship that we hold together. So I won't bore you more with what else we do, but getting straight to the point. So here's the market view. There's a bit of information out on this particular slide, but I'll sort of run through slowly to try and make you understand where we're coming from. So the very first thing is, let's take it from the top to the bottom. So how big is property market? Property itself is $12 trillion market in this country, which basically is 3 times bigger than superannuation and 4 times bigger than ASX. And that's why we call it too big to fail, because everyone is invested in actually getting into property, and in all layers of government, plus every second person is, they own a property, whether they are renting, whether they're living in there, whether they are building investment portfolio, everyone is interested in property. In fact, for that matter, it is the biggest employer in the country, and therefore, a lot of employment is linked with property as well. So residential continues to keep doing well, being the largest portion of the $12 trillion market. And there's commercial component of the 12 trillion, which is 1.2 trillion. So that forms about 10% of the market as well. And overall, these numbers continue to keep changing as the values grow of the dwellings around the country. But it's very good to keep this in mind, that you are sort of, if you're going to make this as your main investment vehicle, and property is already your investment vehicle, then it is pretty safe to play as far as Australia is concerned. And I've been here for 20 years. I've seen market cycles during GFC, even during COVID right now, and we've only seen markets go one way for our clients, which is up. So, and it's not easy to navigate different markets, because there are markets within markets, but you have to understand that, if you have the right understanding of how Australia works, how people move in this country, where they live, before you end up buying a property in a particular area, then, you could be dealing with the right markets for yourself as well. The other important information that you see here is, if you look at the small box on the right hand side, it says outstanding mortgage debt. That's about 2.3 trillion. So if the property market is $12 trillion market, and there's only outstanding debt of 2.3 trillion, it actually means 81% of properties don't have any debt on it. It's debt free, right? If I ask you a question, who owns these properties that are debt free? What would you say? Anyone want to take a stab at that? Are these younger people? Are these middle-aged people? Are these older people? Who do you think are holding that debt-free properties? I just want to make sure you're getting the sound right. Can I just elderly? Okay, so you are getting it. That's great. Awesome. Thank you. Older people, absolutely. Baby boomers, absolutely. And that is where the wealth is predominantly held right now in this country. Now, what happens in the next 10 to 20 years, that these properties are going to get recycled back into the market, and these properties will come in the hands of like yourself and myself. And these are older style properties that people are holding. And these properties, when they get recycled and they get sold back in the market, there's plenty of opportunities to go and improve the values of these properties and actually make a good coin out of these properties. Because, real estate is quite limited. They're only making so much land. And of course, whilst Australia has a lot of land available, but livable land where, obviously most people want to live near the coast side is also quite limited. So such type of properties are actually going to be gold to try secure the right type of piece of asset in the right place. And then, working its way through to make this property feel better for the right reasons. For example, if there's a property on the bay side and it's really, really old, if I can renovate the property and I can put it on Airbnb, I'm going to turn a negatively geared property into positively geared property just with a small hack of actually upgrading the property in the right reason. So that's just one type of strategy that I'm talking about, where you could still be getting positive cash flow or positively geared properties where you're picking up something old beauty, turning it into absolutely new looking property, and then all you're doing is cosmetic renovation on that property and getting yourself, into a really good investment with a good cash flow as well. So there are so many multiple opportunities that you can actually see through when you actually look at data and you see, okay, how can I use this to my advantage? And that's just one of the reasons how you can do that. The other thing is the household wealth held in housing is 56% or 56.2% to be exact. What that means is majority of people are holding their, 50% of people or more than 50% of people are holding their wealth in property. So that's obviously a really good thing to know. And there are about, close to 500,000 properties sold just last year as such in the whole of 12 months, pretty much, with a gross value of around 470 billion. So there's a lot of transactions happening around property every single day. And that brings in a lot of opportunities in the right markets for us. Now, this is a snapshot of what's happened in the market just in the last month or so up to the end of September. And that's the latest data that we have from CoLogic. So if you look at the top band, which is really where the yellow lines are, and that's talking to actually seeing past month, past 3 months, past 12 months being the columns. So if you look at Australia has grown about just 0.4% in past month across all different states if you were to average that out. Past 3 months, the property values dwellings are up 1%, and for 12 months, it's 6.5%. So even if interest rates have sort of stayed really high over the last 12 months, the overall at Australia level, dwellings have gone up 6.7%. So, a lot of people talking about they can't hold properties at the moment, interest rates are really high, but properties are still getting transacted, right? And the market values are going up for the right properties in the right areas. And overall, if the data is still showing that 6% the value is up, my question is, are your properties growing at least at 6%, wherever you are holding your assets today? And if the answer is no, you need to review your portfolios and see what has been the growth rate for your properties and actually see if there is any opportunity to recycle some of that and not get emotional about the properties that clients usually hold. So that's way how you look at the data from national perspective. And then you can break it down. If you look at the regional and capital, it's sort of sitting at similar numbers. So it doesn't matter. Most people talk about, I only invest in metro and not in regional. But regional, the word regional, people, look at this very differently. Just the word itself can sometimes put people off, word regional, but there are many large regional areas which are cities in its own right. For example, Gold Coast is regional, but it is a city in its own right. In Melbourne, we've got Geelong in Victoria, which is also regional, but it is a city in its own right. And so is Pakenham in close to Melbourne, southeast, which is also regional on paper, but it is a city in its own right. So looking at that perspective, if you change that word into saying bigger, larger areas where you've got good economy going, there's a GDP growth in that area. Of course, people want to live there, high demand, low supply. That area is going to grow. And if you look at the national level, the combined regional, combined capitals are sort of similar returns, right? So it's not going to, and I'll show you some more slides that will actually validate that the growth rate for at least the last 1 year has been quite similar in capital and also in regional areas. Whilst if you break them down into now different states, and you look at regional and capital below that, the red band that you see is all about regional markets in different states. And what's highlighted there is regional WA, South Australia, and Queensland, both, in fact, from past month, the last quarter, and the last 12 months, they've started to vary now. So Perth has been leading, and we know that for the last 15 to 18 months, Perth has been doing phenomenally well, with nearly regional WA being at nearly 20%. And its counterpart, South Australia, is around 10%. Queensland is around 12% for the year. And but the good news is that they're all growing, right? It's not about trying to capture 20% market. It's about actually going in the right markets to be able to start getting the right returns. Now, in regional WA as well, there are many suburbs in regional WA. And at the suburb level, there are many suburbs that are actually giving an average return of 24-25% over the whole 12-month period, as opposed to 19% that's written over here. So you can see how you sort of, when you try to uncover the data at the lower levels, you can see, your returns can be phenomenal, especially when it comes down to individual properties as well. So in this data, what we are seeing here is that Tassie is sort of not doing that great. Regional Victoria is not doing that great. And regional New South Wales is sort of above the waterline right now, but it probably compared to WS and Queensland is far behind. Now let's talk capitals. In capital as well, you've got Canberra, Darwin, Hobart, Melbourne, sort of negative or probably a flat line, I would say. Sydney also hasn't moved much than its regional counterpart, but the capital cities of Perth, Adelaide, and Brisbane are in sync with their regional areas as well. So those three states is no brainer. If you've been in the property market for the last 12 months hunting properties or have bought something, you would be quite aware of it that these states are doing phenomenally well. Now, there are many people who live in Victoria or any particular state that you're part of, and you have no access to how can I go and buy properties interstate. You always have that opportunity to utilize the right services. You can talk to us. We can get you going there without even you having to go there. But you know, the best opportunity is not always in your backyard, okay, or around where you live. So you need to come out of that shell that I have to buy all my properties in one area. I have to invest where I live because I can touch and feel the property. I am quite emotional about what I buy, so I'm going to hold them for longer, even if they're not doing well. I'm okay to go through the pain of negatively gated properties over these years, because at some point in time there will be a station coming near this place. There's good schools around it, and I know it's going to actually get me the good return. But that one day is going to be way too long before you can actually realize that you have gone for the next 10 years and your property portfolio hasn't really done much, right? So you really need to bring agility into your property portfolio thinking and actually use this sort of data to really look at the opportunity. Where is the opportunity? Do an opportunity cost analysis on your existing properties to really see, okay, if I was to sell something in today's market, for example, you're in Melbourne and you want to sell, your property is not doing well. It's a $600,000-$700,000 price point, and you bought it for about the same price point maybe 3 years ago, and it hasn't grown much. But you're waiting for another $50,000 for it to go up after a few months before you're going to sell it. The problem with that is that by the time it gets to that point, you're also losing out opportunity in other markets, in other states that are already steaming ahead. So for a 2%, 3% growth that you're waiting on your own property, so you're not going to sell it either in loss or you want to make a small coin on that, and you've gone through so much pain, you're actually losing opportunity in markets that are screaming at this stage and getting you double-digit growth. So think through all that, because that's where the opportunity cost analysis need to be done on properties you hold. So it's important to keep market view in mind all the time, what's going on, and actually then make the right decisions for yourself. Now, a lot of people ask me, why do properties keep going up in this country? What's really happening, and why is this happening? So the most important bit is that you have to look at some of the levers that are actually really work well in Australia as a market, and people tend to start comparing this with UK and US and Canada and other markets, and they try to play that around that those markets hasn't moved. We've seen historically how things have worked there, but Australia will follow the same. It's not like that at all. Australia is a completely different landscape. It's completely different demographics. The whole setup is completely different to other countries. Yes, there are global constraints and consequences of things that happen globally, but majority when it comes to property, it's a completely different kettle of fish when we look at how property is growing in this country. So few things that really make a key difference on property growth is supply and demand. Now, it's a very common thing to know what supply and demand we're talking here, but we're talking both in terms of rental and housing as well for sales that we're talking about. And we've generally seen with obviously an influx of population that we've had in migration, and you can see a graph right below that, which talks to, it's probably a bit small to read through, but overseas migration in 2022-23, the net annual gain is 518,000 people who flocked in this country in just one particular year. So usually on an average over the last 10 years, there's about 350,000 people that have been coming in every year as a net migration, more or less around that number. And what we are seeing here is 518,000. So that is significantly more than what you would normally see as an average over the last 10 years, which means a lot more people coming in this country. Where are they going, right? They're not going to cities where you and I live. They've been sent to cities where they want the migration laws are set in a way that they can get the PR. So if a doctor comes from the UK, they're not going to stay in Melbourne CBD. They've been sent to regional areas or remote areas where they can service, where there is a need and where the government wants them to go so they can actually get the PR. Now, usually the PR rules are such that if you were to send somebody off to remote areas or areas where you and I don't want to live, they have to stay there for 3 to 4 years, right, before they can get their PR. And that's long enough time for someone to really make a decision on whether they want to live there or not. But what's happening in those areas is those smaller areas are becoming bigger areas because suddenly there is an influx of people coming in that area. The right type of infrastructure is being built out with billions of dollars or multi-million dollar investments that are happening at the same time, but not enough construction in terms of actual dwellings. So that starts to put a lot of pressure on existing properties in those areas, which actually means that the prices continue to keep going up as a result. Because if the people are not purchasing initially, obviously they're renting. You and I, we've all been migrants in this country. I came 20 years ago in Melbourne. And of course, by the time when I was renting, in the initial few years, then you go and buy your own house. And of course, then you sort of start buying investments, which is usually what people do. Now, when someone's landing in this country and they've been sent to remote areas, obviously they're renting. So there's a lot of rental pressure as well because there are only so many dwellings. Now, those who have already gone through the curve of going to the rental market in the same market, they are now ready to go and buy their homes. And if they're buying homes in the same area, they're also buying the same stock that's available to anybody else in the country to be able to secure the same properties. So right now, as an example, areas we are buying properties in regional markets in South Australia, Queensland, and WA, they're flooded with a lot of buyers at this stage. There's a lot of demand. We're talking 10, 15, 20, 30 offers on a single property. That's absolutely insane. And if you talk to someone who lives in Victoria right now and talk to them about that there are 30, 40 offers, and they're like, where is this world? Because they have not seen this for the last 3 years, including myself. I live in Melbourne, and we haven't, seen this type of market for the last 3 years. Not to say that's not going to happen again, but that's the reality. So you can't buy properties just based on what's happening around you. You have to look at every market is different, right? And why those markets are growing, and why is that your Victoria market is not growing, or New South Wales is not growing as much as the other states are growing. Now, there's an argument to that. People talk about, of course, the property market in Victoria has been obviously right now being impacted by the government actions, and that's true. But that's not the case for New South Wales, though. But New South Wales is not growing as much as the other 3 states are. So the important bit there is the affordability factor, right? How many people can buy $1 million property as compared to $500,000 property? So it's an important categorization when you're choosing to buy investment properties. Look at the price points you're buying properties at. Is that affordable, and how many people can actually really buy that type of properties? And that will allow you to be able to see things through differently, and you will be able to see how someone can actually maximize their outcomes by buying the right type of property, the right affordable type of property in the right area on the right street to be able to maximize their returns over a period of time. So supply demand plays a huge role, and you can see a graph on the right hand side. Sorry, I'm just going to turn on my camera now. It's going to start working. It wasn't working all this while. Perfect. Here it's working now. So on the right hand side, you can see there is the dwelling sales versus stock available for resale. So what you're seeing there is over the last 10 years or 15 years data. The blue lines are actually properties that are actually the dwelling sales, the sales that actually happened. So 640,000 sales that is showing in 2024. Whereas the actual dwellings that are available for the same time frame. So listed properties for sale is only 165,000, the red bits. And you can see how the red bits are sort of starting to fall, which means the number of properties available for sale in the right markets are also going down, whilst the demand continues to go up. And that's a significant difference in terms of demand and supply. And if you actually look at over the number on the right-hand side, the supply in months. So with the current supply of properties that are available over there, what we are saying is that supply will actually, if there's no new property coming to the market, in 3 months' time, that supply is taken away completely absorbed by the demand that currently is there. So $640,000, dwelling sales versus stock for resale is a huge difference to showcase that how supply demand is so skewed at this stage. We have not only low stock levels, but even the new dwelling approvals are extremely low at this stage. The key statistics below that in August 2024 seasonally adjusted estimate is that total dwellings approvals have fallen around 6.1% to just 13 or 14,000 new homes to be built. And that's just for the last month. And overall, the trend line has been quite low of approvals on monthly approvals of around 13 to 14,000 housing only, whilst we have this significant demand coming from migration both from interstate and also from international migration that is happening. So the net migration is way higher as compared to properties either being built or existing stock that's available. And in the near future, this problem is not getting solved. This is a government problem. And I remember 20 years ago when I came in this country, first home buyers struggled then. The first home buyers are struggling even today to secure something that's right for them. So you have to continue to keep seeing how the economy continues to play here. But migration is the lifeblood to this whole game of property. And as long as that continues and we keep the trends going the same way and we keep moving with the trend of how people move, how the demographics move, how the shift of baby boomers is going to Gen Z, Gen X, Gen Y, Gen Z, Gen Z, and then beyond that, and how they look at properties right now. An 18-year-old right now looking at a property versus a 60-year-old person looking at the property, that there is a significant shift in the mindset. So you have to look at those things of how people buy, what are they buying, and what sort of properties really are useful for them. For example, if you talk to younger crowds, they are not interested in buying big houses. They don't want mansions. They want small spaces. Right? They want something that is functional, usable, that they can use and they're done with. Right? But if you look at baby boomers and you look at even Gen X, we are used to big properties. We're used to backyards. We want front yard. We want backyard. Although whether we can maintain that or not, that's a separate thing. But that's what we want. The bigger the houses, the luxurious the houses, the better it is. But that's not the case for the new generation. So you have to look at how the property market and how people are going to buy in the future, right? And get ready with that. So if you have big land sizes, for example, on a property, let's say it's a 600, 800 square meter block. You've got a house in the front which is 3 bedroom, 1 bathroom. And that house can be expanded to another bedroom or maybe another bathroom. That's a functional home that can actually expand to better value. And that means then obviously, there'll be more demand for it. The prices can go up because you can add a bedroom or a bathroom. And behind the land, you can subdivide that into building 2 townhouses and sell that because the younger crowd doesn't want big houses, right? So you have to look at opportunities today. You may not want to subdivide and do all this, but you have to look at when you are going to sell this property, who is buying this property at the end. Most people don't look at exit strategies at all. They only look at entry point. And that's not good enough for you to be able to look at, okay, I can enter into a type of strategy or investment. How am I going to exit from this investment? So think exit before you think entry. And to think exit, you really need to look at a time frame of how long are you going to hold the property? And if it's going to be 5 years, what do you anticipate the 5 years will do for the area? And who will be the buyer for this property next? And what can you do with the property that you can modify to be able to get the best outcome as you hold these properties as well? So I think I'm covering a lot of the aspect of how we look at property, what we do, but it is really important if you want to make good coin out of it and not be a traditional investor who's buying and set and forget sort of 20-year game, which doesn't work with the catastrophic events that we have seen just in the last 2 decades with GFC and COVID. And there's something happening every time. The war, inflation's going up and down, economic situations are changing. You cannot keep your portfolio like that where you haven't looked at it for the last 5 years and just there for you to give you something in hope in the next 10 years. So the conversation I'm trying to drive here with you is the key message here is that always go top bottom and look at trends, and that will help you decide where people are going, what are they buying, why are they buying there, why they want to live there. Then just standard thing of having hospitals, infrastructure, schools, college, all that is given. That needs to happen. But it's the consumption part of it that changes all the time. And especially every 5 to 10 years, that consumption is different. The type of people, what they want out of this property is different. So think through all that as well. So population boom, migration, economic conditions, government spending, where that's happening, and that has to go in hand where they're building new construction, what's going on. Sometimes that is not the case, and that can also skew up, prices as well. So, but these are the fundamental elements of trying to see exactly how you look at that. Now, cost of construction, I haven't touched. I want to talk a little bit about that. During COVID, we've seen obviously the cost of construction have really accelerated about maybe 30% than what it was prior to COVID. just by and large sort of thing what I see in the industry. Now with that, obviously, if the cost has gone up, the cost isn't coming down. That's not happening because inflation is obviously real inflation, and that inflation is going to continue to keep pushing prices up. But you have to understand that if you're building something today and you're buying a land for say $400,000 and you're building another for $400,000, and the whole build is now becoming $800,000. In that new development, if there are multiple houses being built with a similar price for around 750, 800, and if the established homes are sitting at around 650, 600 ish around the same area as well, those established homes are going to definitely go up in demand, because the first thing that people will do is that why am I building something for 800K when I can buy something for 600 in the same area? And they will go and actually try to secure the property for 600 so that they can actually get the benefit of that. So property prices rise as new dwellings are being built with a higher cost at this stage, right? Whether you should do that or not, it's an analysis for a particular area, for a particular type of property that you're going to build. And if it's your home, of course, it's a different thing altogether. But when it comes to investment, think twice if building is right for you. But the construction cost is not going to come down. There were a lot of people who asked me that question. That's not happening. It will. It's got better now. Of course, the raw material cost has gone down, but it is obviously high as compared to what it was before COVID. So, and as a result, obviously the dwelling approvals are also low, and we're not building fast enough then to the demand, and that consumption is obviously causing a lot of issues in terms of people to able to secure properties. Lots of FOMO out there at this stage, but that's a good news for investors who've held the properties, and their properties continue to go up. That's why you see in affordable markets like WA, SA, and Queensland, when there's suddenly so much demand created and billions of dollars going into the infrastructure, the property prices have been going up in double digits essentially over the last 3 to 4 years since COVID has started. I'll show you another graph right now and walk you through the last 5 years in phases of how prices have shifted, or the rate of growth has shifted over these different states. And you'll understand that better what I'm talking about. But that's what I had to cover. So this is a summary of all the states with the median values where we are. So as you can see, we've got Sydney leading the path with 1.18 million median price point. We've got then the second one being Brisbane, 881,000. We've then got Canberra, which is 844,000. Then we've got Adelaide, $800,000. And then we've got Perth, now 797, Melbourne just trailing at $777,000. So that's really where the average median price points are sitting for those states, which basically means that if you were to cluster them together, apart from Sydney, everything else is pretty much close to it. And of course, Hobart and Darwin is way beyond, but most of the states are pretty much tracking to where they are. So this was not the case 3 years ago or 2 years ago, right? Perth was sort of in the 500s, whilst Melbourne was still trailing was around 750, 800K. So there was a huge gap, and that's what made those markets affordable. Same for Brisbane before COVID, for example. Brisbane was around 500, 600 mark and sort of turned around 750, 800 around COVID, and it's continuing to go up. But these markets have now shifted. So if you look at now that if these all markets are at the same price point, where should I invest? And that's really a question to ask. Is Perth going to continue at the same rate? Now that has played the catch up, or is a market that is not moved much right now is where the opportunity is. So some of these things, the data has to be understood, it has to be played back. A lot of the experience comes into play as well. It's not just about data. Data only allows you to be able to look at the numbers, the facts that you have on the ground, and then you use your experience to choose the right markets for yourself. But Melbourne sitting on the 6th number in the ranking doesn't mean that Melbourne is actually sitting on the 6th. What this data doesn't tell us at this stage is that there are actually in Melbourne, there's twice as much as townhouses or units market, which is as compared to Perth, for example. And therefore, the data is going to be skewed at the median value. Therefore, it's not a true reflection that Melbourne is on the 6th ranking. It's not the case. It's just that the dwelling style of Melbourne is very different to Perth, and therefore it cannot be compared just with the median value as such. Now, with the update with September, of course, as I said earlier, at the national level, we've had a modest increase of 0.4% for the very first month of spring, but that has been now a rate of growth has started to slow down a little bit. right? And it's broadly been the case for July, August as well, which has been only an increase of 0.3% as compared to previous quarters or last year. So this slowdown in growth, what I would say rate of growth, is important. It is recognizing the fact that the prices are at a point where most markets are at the equilibrium position in terms of the price, the median price point that we just looked at, that most states are sort of sitting at hovering around the 700, 800 price point. So now the question is, where do I keep buying? What should I do? Because most markets you can buy a similar product at the same sort of price point. So where is it making sense to do whatever we are doing? And that's why I think it's at a point where you have to use your experience to get into the right markets, and that's what would help. There's also been a flow of net new listing coming out of the market, which was tracking at 3.2% higher than a year ago nationally, to be now at 8.8% higher than previous year. So what that means is some of the areas like Melbourne has high listings as compared to some of the other states. So there is this slowdown means that marginally we are seeing listings go up, but that may also be momentarily right now because traditionally we know that October, November, December, these are the months where markets start, spring markets, really where the markets start to swing, and there are a lot of sellers who will come to the market to sell properties. So listings are expected to come on the market, but the demand right now is more to do with the buyer sentiment as well. So the consumer confidence right now is improving, but not to that large extent that it was 2 to 3 years ago before the interest rates started to go up. But we do think that's going to return back very, very soon. So if you have any questions, please put all the questions in the post there. I will sort of go back to them when I get there. So I want to get through the slides and then we can take the questions. Now, the key problem. So the key problem right now with our markets is, of course, inflation. We haven't heard about RBA so much in the last 20 years that we're hearing them now. In the last 2 to 3 years since COVID has gone up and we've got this interest rates going up and RBA is all over the news every single month. We all wait to see what they're going to do. But it is a reality that inflation has been quite high, and it is now sort of coming to the point where it is coming close to the 2 to 3% target range. So the inflation for June quarter was 3.8%, and for the headline inflation for August is 2.7%. Now, that's also happened because of petrol subsidies that government has given in, that has actually got the inflation lower to 2.7%. If you remove the petrol subsidy out, you would have all noticed that the petrol prices have gone down. That's because of the subsidy from the government. If you take that part out, the inflation for the August actually sits at 3.5%, not 2.7%. So what that means is, I'm not an economist, but what that means is that we've got a bit of a way to get back into the band of 2-3%, which RBA is very, very adamant to get into. And they are anticipating this may happen in the next 6 or 8 months. And every time RBA talks and makes an announcement, they're talking both the things. They're talking about cash rates might go up, or the cash flows might even come down. So that actually confuses the market even more. And that's where the sentiment of the consumer is. Should I buy? Should I not buy? Because I don't know if interest rates are going up or down. But what I'm talking to you right now is that let's try and have the conversation beyond the interest rate to get the right benefit out. Later in the slides, I'm going to show you some commercial properties as well that you can actually buy positively geared properties regardless of what the interest rate is. It doesn't matter, right? That is a way out of every problem that we see. You can get into Airbnb properties. You will be, into positively geared properties with Airbnb. Doesn't matter what the interest rate is. It's just about thinking differently and buying the right type of property in the right, in the right areas and with the right strategy in place that can work. Doesn't matter what the market conditions are, but you really need the right understanding before you can go and act on it. So now, but what will happen is this is really interesting data right now because the next 6 months is going to be phenomenal. Whatever you end up buying in the next 6 months, or you're already holding now up until the next 6 months, we believe, and this is just us predicting, the markets are going to be in upward swing. The reason for that is that central banks have slashed rates, US, New Zealand, Canada, UK, but Australia hasn't as yet. And the question is, when is that happening, right? Now, we know that the banks are already cutting their fixed rates. In fact, NAB just did that a couple of days ago. And they have trimmed 0.5% of their fixed rates for both principal and interest only and loans, I believe, for both investors and owner occupiers. And the other banks are going to follow as well. So if the fixed rates are coming down, what they're telling the market is that we want the consumers to go and lock themselves into these new lower fixed rates, and people will get motivated right now to go and secure this fixed rate because the number looks lower than what they're holding right now. A big warning there, and this is not an advice. Please talk to your mortgage brokers if or your consultants or your finance consultants if that is the right thing for you to do, because to me it is a trap, right? This actually is a big indicator that that the cash rate or the RBA is going to move down next. When? No one knows. But if you fix yourself now, even for a year or two, you might be getting into the point where interest rates will come down quite significantly, and then you're not going to get the good deal. And again, this is just a prediction from my end, but in individual circumstances can be very different right now. So please speak to your brokers or your bankers as a result of that. But if you look at on the top part of what I mentioned, ANZ has predicted that the current levels of cash rates with the first rate cut will be around February. NAB's holding a similar view around cut rates around in May. Westpac talks to that being happening in February as well. And then we have CBA who talks about that happening, the first rate cut being around December. They're still quite bullish about that right now, and they still talk about that happening in December. December is not too far away. We are almost in mid-October. So we're only a month and a half away to see if that really happens and if their prediction comes well. But the good news is that all major banks are predicting that there will be a rate cut in the near future, which if you look at from the timeline point of view, we're talking nearly the next 6 to 8 months. So that is absolutely golden time right now to get yourself out of the bed, get your finance ready, and actually go act and do something now, because when interest rates will come down, even if there is one interest rate cut that will happen, markets will swing, right? People will open up wallets because consumer confidence shoots up, and at the same time, people borrowing capacities will open up and people will go and buy properties, right? It is really important that you look at this in the light of you making money, timing the market. A lot of people say you shouldn't time the market, just buy the property, and it's all about timing the market. I challenge that, especially when if you have a professional by your side who knows the stuff, breathes this stuff day in, day out, you can actually time the market to maximize your outcome, to get into double-digit growths, or so if you were to do things the right way. So, and again, I'm not making any claims here, but all I'm saying is that you would do better than average if you were to really look at this data and use that for your purpose of what you want to achieve. Now, this is an interesting slide, and I want to run through this a little bit differently for you. What I have lost on the slide is this was meant to happen stepping through the slide, but it's all come up all at one go. There's no stepping in this. So I'm going to just sort of try to maybe talk through it a little bit for you. If you look at on the left-hand side, which is from 2015 all the way up to 2023, let me just actually modify that a little bit because you're not going to be able to see things correctly on the slides. 1 second. Okay, maybe that's a better view. So I'm just going to present again, if I can, or if I can. Sorry. I'm going. Sorry. Sorry about that, guys. Okay, maybe that's just fun. Yeah, that might be a better view. You can see that now. So is that better for you guys to see? Does it only show? Is the view better now? If you can just push that in the comments. Okay. All right, that's good. So what I was talking about is, if you look at on the left hand side, you've got 2015 all the way up to 2025. It's the last 10 years that you're seeing on the screen. And what happened in the first 2015 to 2019, we had APRA and Royal Commission. So APRA actually had a ceiling on borrowing capacities, with all banks mandated to actually adhere to those ceilings, which basically meant that doesn't matter, based on your borrowing capacities and so forth, you would hit a ceiling at a point where you cannot borrow anymore, because the interest rates would be whatever it is at that point in time, and bank would not allow you to borrow beyond a certain point because of the ceiling that APRA had set. What then they, as a result of that, the rate of growth of markets sort of continue to stay more or so on the sideways, and that's where you can see most of the markets in the very first 4, 5, or 6 years from 2015 to 2019 stayed almost, in the band of 2 to 3% that you can see. Now, what happened after that is that APRA then changed the rules, and then they said, okay, well, let's remove the ceiling, and every bank has now got the ability to be able to raise the floor of the ceiling just about maybe 1.5 or 2% above the current rates that you would have, which means every bank would have different rates, and that means obviously the ceiling would apply differently. And that actually opened up a lot of borrowing capacities for people, and they went and started to buy properties. And at the same time, in 2019, if those who are here would remember that towards the end of 2019, before COVID started in March 2020, what we saw is that there was an absolute V curve of markets sort of swinging back, and coming back really strongly because of 2 interest rate cuts that happened in mid 2019. And we saw that a big run that happened all the way up to early 2020, to the point that we then had, after the rate drop, we then had COVID. And the very first year of COVID was obviously a bit slow, or maybe the first 6 months, because people were dealing with the healthcare. But then after that, the life sort of turned all normal. Now remember, there was no migration happening during COVID in this country, but a lot of people continue to keep buying properties, in the markets, because they started to see that obviously government started to hand out a lot of money to people and free money to people, and that money sort of meant that what people were doing were using that money to be able to invest. Plus, a lot of people sitting at home during COVID with lockdowns saved a lot of funds, and that money was utilized again to put it back in the market to be able to buy properties. And as I said, stock levels have always been low, so that really took off on COVID, and all states started to go up. Now, if you particularly pay attention so far till here, Perth, which has been a purple line since 2015, has been in a negative growth for a good 4 to 5, 6 years. In fact, that has been the case for the last 15 years until recently. And then Perth started to take off in 2019, just after COVID, but it only reached a point of growth of about 10 to 12% at its peak in 2021, alongside Melbourne, and it did not go right till the top. Whilst the other 3 states, being Brisbane, Adelaide, and of course, we are also talking about Canberra, did really, really phenomenally well around this time frame, and they peaked around 25 to 30% in COVID. And then once towards the end of COVID, the rate of growth of the properties started to fall down in those markets, because obviously it reached a point where it was now the price points were not sustainable. So a lot of things started to come down, and we started to see 13 rate hikes happen at the same time. Now, as a result, people were back into the fear mode. What's happening with the rate rise? Obviously, suddenly there is a block in their borrowing capacities, because so many rate hikes means that now you can't borrow anymore. And because of low supply of money available to people, suddenly, obviously, the rate of growth dropped because there were less buyers as compared to COVID timeframe. And now what has happened is that people have got used to those 13 rate hikes, because the last 12 months hasn't seen a rate hike. And it has been pretty much flat at 4.35% cash rate that we have seen of nearly 11 months now. It started, the last time it was on hold last year was in November, and after that it hasn't gone up since now, until now. So the 11 months we haven't seen a rate hike, which is great. But even then, what happened is towards the mid-end of 2023, which is just last year, didn't matter what rate hikes did, the properties again, one more time, started to go up, regardless of what was going on. Now, in this scenario, rates, if you think of it, interest rates are high, people aren't able to borrow, but people are still buying. right? That means a lot of people actually had equities, people had money in the superannuation, and they still went and borrowed money even at high interest rates and still kept going, right? Until such point to get that maximum growth, and therefore you see how Perth has sort of played a catch up in all this time, and the other markets that had boomed during COVID also boomed in this time frame in the last 6 to 8 months, but not as much as Perth, because all Perth did is catch up, right? And because of all these catch ups from different markets, we are at a point right now where the rate of growth has sort of started to drop, and you can see that Perth sort of sliding down. So is Adelaide, and so is Brisbane, but very strong double-digit growth markets. Now, talking about Melbourne's been a bit of a kicker right from the last 15 months, 18 months since government announced a few things that were not savvy or investor savvy at all, with introduction of land tax and so many new introduction of new rental laws, and at the same time, of course, people were not happy with the new compliances on the rental laws as well, and that's pushed a lot of investors into other states, including Perth, Brisbane, Adelaide, and Melbourne sort of started to drop. And in fact, Melbourne hasn't seen much growth over the last 3 years. So it's at a point where it's fundamentally such a strong market, but it's just that the operability factor of Melbourne or Victoria hasn't really helped its growth. So there will come a time where Melbourne is going to bounce back quite strongly, and we do think that's going to probably be another 6 to 8 months, or maybe even 12, before government actions are reversed, or with the state elections coming there, we do think that there will be some sort of movement for this to get better for Melbourne. But it's at a point where all these markets' growth that you have seen, or the rate of growth declining or going up, has to do with the economic cycles of the area, what's happening, and that's what's driving the key outcomes for such areas. So you have to understand that, the broader picture is always good to know where we are we standing, what are we talking about. As you can see, the top growth markets, if they're pointing downwards, doesn't mean that they're going to follow the curve of post-COVID, because in the next 6 months, as I said, if the interest rates do come down, and that's been what we are all looking forward to, which means then the slowness in the rate of growth is only going to be short-lived, and the markets will again swing back into the V curve, and we go again. Right. So therefore, if you were to look at as timing of the markets, you can look at how, if you play well, you can time the market for short term, but as a long term, you need to also make sure that you qualify the right asset for the right areas to be able to buy the right thing for yourself. And that's why the consolidation that's happening with the bigger markets there, being Melbourne, especially, Hobart's obviously kicking off there right now, and it's still in the negative growth, but it is coming to a point where it will start to now head up a little bit. But Hobart is still a very small market as compared to Melbourne, so you will find yourself that given median price points are similar in all major states now, there's opportunities now in other parts of Melbourne. So if I look at now data more than 10 years old, this is over 54 years, and I talked about the topic being property is too big to fail. This is from 1970 all the way up to now. So what you can see is that those red bars that you see on the screen, they are decades. They represent every decade. So from 1970 to 1980, then and so forth. So the green line is the property dwelling prices in Australia right from 1970 until where they are now, or just around COVID timeframe for that matter. What's happened in this time frame, which is nearly 5 decades, we are talking about home loans. Interest rates were quite different: 6.5% to 10%, then 10 to 70%, 17% to 6.5%, 6 to 9%. I've seen interest rates in this country when I was here at 7.5%, 8% as well, and even for that matter, touching 9% as I came in 2004. And then it significantly dropped after that, with close to around 4 to 5% that were around for a good 10 to 15 years for us, until such point that it has now gone up because of inflation that's hiked up temporarily. So regardless of where the interest rate was, what you see at the bottom, the green line, continue to go up. And so inflation has also shifted along these decades, but the house prices have been phenomenal over these years. right? So those who look at from a long-term perspective and keep the bigger picture in mind, as I'm always trying to focus on bigger picture, you can see that you're not going to go wrong when you are investing in the right markets. And if you were to overlay data with your experience, you can really get this right and get into the right type of markets to really get good growth on your properties. So that's really what I had to do with all the data presentation to you. We're nearly an hour right now, but as I mentioned, I do want to make sure that I cover a bit of commercial aspect of the properties that we buy right now, because that should give you a good understanding of around how properties are doing well. One thing I forgot to mention, with unemployment rate as well sitting at 4.1% at this stage, it's sort of at a point where that is acceptable range for RBA. They would want to see it at that point in time. During COVID, we had the lowest unemployment rate sitting, and in fact, it been the lowest in the country for historically. And now it has sort of edged up to 4.1%, which is where I believe RBI would want that rate to stay for them to make the next move down. So I think that's tracking okay. The job markets are getting better right now. I'm hearing that from people. But of course, it's something to keep watching on what's going on with the economy. I don't think, in my honest opinion, government would want this to go into recession at all. Nobody wants this country to go into recession. So they'll keep doing what they have to do. In fact, government is now trying to subsidize. As I said, petrol prices were subsidized in July. So we've seen the impact of that in August with the inflation coming down. So I think there will be a play on both sides to try keep this out of recession. But the important bit is playing the right market at this point in time. Doesn't matter what governments are doing, but keeping that in mind, you just need to be aware of these things. Now, we buy properties through different strategies, but I really want to just sort of talk about, show you some commercial properties. So, for example, this is a medical center we bought for a client recently for $455,000, where the net rental is $40,838. The net yield is 8.9%, and the net cash flow is $15,000 after the interest component. So you can see, like, if you were to buy this in cash or you don't have a loan at all, you still got $41,000 coming in your home every single year, right? And that rent will keep going up every year because of CPI increase. That will happen at the minimum. But if you do have a loan, at 75% LVR, you still have a positively geared property, which is $15,000, and that's not bad for a price point of under $500,000, right? Go buy $500,000 residential today. You're going to be negative $12,000 to $15,000 right now easily, if you were to even be at 5% yield on gross levels. That's another one as an example for $780,000. We bought this in Make My Property, so that's rental of $72,500, and the net yield is 9.29. The cash flow is nearly $30,000. This is in Queensland, and the Westpac's been there for the last 30 years. Most people say banks going to, they're turning off. Obviously, Westpac is known to shut down the retail. That's okay. But the location matters, and you can replace that with the right tenants in the right place. Point is that if you're buying something in Metro for about $1 million or $800,000 and going negatively geared heavily and being negatively geared around $35,000, you can turn that into positive cash flow. I had a doctor couple come the other day to me. They had 4 properties, and each property is negatively geared around $35,000, which means all they're doing right now is that they're holding a portfolio of nearly close to $3 million, but they are, just to hold that portfolio, which is also not growing over the last 3 to 4 years, they're negatively geared around 120 to 130K. And they came for advice, what should we be doing with these properties? And that's what we help with, because we really want to make sure that people can see through beyond those properties and actually, make sense out of how you can turn a single asset from negative 30 that you're holding into something like this, which is positive 30, and you can see the shift, in your borrowing capacities, and for you to keep going into buying more properties for yourself. That's a property that I just bought for myself, settled in 31st of August. So it's a 900K property, one single building. It's got a resi-commercial, which basically means it's a mixed use. So you've got residential and commercial, and we've got 5 tenants in there. So there's a cafe, there's a retail shop, and there are 2 residential on the top, 1 studio at the back. This is fetching me a net rent of $78,000 plus outgoings is separate, which means with my cash of $285 that I paid for this property, my cash flow is $26,000 a year. And the way it is set up is this is going to pay off the loan for me in the next 15 years. That means it's going to be debt free after 15 years, and that also means that the net rent at that point in time will be close to around 120K, which means this is a passive income of 120K debt-free asset, in 15 years as a result. So, there are good deals out there that you can think differently and set you up the right way for your retirement as well. So you just need to really think and look at things differently. This is a $1.1 million property, corner block, 400 square meters. It's a funeral, being the actual tenant. They've been there for the last 16 years, evergreen business. I don't think they leave the premises because in that area there aren't too many funeral services as such. So with net rental of $89,000, you still have a net cash flow of $30,000 for yourself. And the story just repeats. So I'm not going to go too much into those details, but I just wanted to share that, there's a huge opportunity out there. There's an opportunity every day. It's just a matter of what your belief system is and how you perceive risk, and how we see risk is very different. So it's all about opening up, to avenues, learning more, understanding how to actually buy properties. And if you really want to follow us, we have a Facebook group, I Love Property. If you're not on it as yet, you can scan this, join this, and we are very, very active. You can ask your questions, and we are happy to answer questions there as well. And the intention is to bring more webinars to you, get more knowledge, experience that we have to share with the group, so that you can learn more and take action for yourself and get into better positions for yourself as well. So that's really what I had to cover today. And with that, I'm going to spend maybe another 5 minutes just answering the questions I see on the on my screen. But that's really how much I can do today. So give me a few minutes and just go through all the questions if I've got anything here. Thank you for those being active to put the questions through as well, because I know it's hard to type through whilst I'm talking. So Amy had a question. Can you expand on more on development cost? Example, 650 square meter land a day, then potentially doing a second dwelling on knockdown, rebuild 2-3 dwellings. How construction is challenged in today's market? Look, I mean, Amy, that's a question where if you're looking at a development opportunity and a small townhouse development opportunity, it's more about to see the future values of the properties that are being built at the higher price points right now, and how you could envision a market to look like at that price point, at selling point. Because when you're doing a feasibility analysis for a 2 or 3 townhouse development, for example, and you're looking at past sales and you're comparing that data with your future projections, you're not going to get the feasibility right if there aren't any new developments in that area as of now. But also depends whether it's regional or metro for that matter. But as I said earlier, that any cost that's going into development right now, people do like to build new homes. That's going to continue to happen. But in your case, if you were developing something which is, there aren't too many new dwelling properties to compare against a price point, then you could be in it for a while before your property would sell. And if it does sell, you may not make enough profit that you actually anticipate at the beginning. So the best way to look at this is to first, dissect the market and understand which market you're going to be playing in. Look at how much data is available. But I think we've moved away from this whole construction. So the construction cost has gone up, three years ago now. And there should be now a lot of new developments in established markets or metros. And there should be sufficient data to be able to compare against recently sold properties that are brand new built. So you shouldn't struggle that in metro, but regional could be a question mark right now. So I hope I answered that question for you. Rohit saying NAB is also predicting that first rate cuts will happen in February and not May. Okay, they may have updated the prediction. Yes, of course. I mean, this is an everyday game, Rohit. So whether it's February or May, my reference point to this is the next 6 to 8 months is going to look very lucrative. And therefore, there is a window of opportunity right now. So Sudhir is saying, above any indication, any unemployment trends and connection to the property market versus inflation property value? Yes. So the current unemployment rate, as you pointed out, is 4.1, and I said that I don't think this is going up, and the governments are obviously looking at this with a microscopic view to make sure that we don't go into recession. So I think it'll stay at 4.1%, and I'm quite. And that's the number they wanted to achieve anyway, from 2.5% unemployment, about 8 months ago, or even just after COVID, to now. They wanted to achieve 4.1%, and that was one of the criteria I believe that RBA had, that unemployment should go up. Otherwise, the market is not going to. Sorry, the economy is not slowing down enough. And now they have achieved the unemployment rate, and I don't think they're going to look at bringing that down any further or rising that any further. But they are now looking at this inflation number, which they want to bring in that 2 to 3% band. I think if they come close to it, there is enough pressure on RBI to make the move. But again, I'm not RBI, I'm not an economist, so my guess is as much as yours right now. Having said that, we are very positive with markets swinging for all of us in the right direction. Mohit Goyal's great presentation. The big reason for upward direction for property market is long-term immigration in Australia, but will that remain the same? Australia is reducing the PR application year on year, massive cuts in student visas month on month. Overseas visitor arrivals are reducing by 2%. Overseas visitors departures are increasing by 9%. All data are available in public domain. What's your thought on the other side of the coin? Look, Mohit, whatever happens, it happened at a point in time, right? You have to look at a bigger picture in this. I've been here for 20 years and I've shown you data of last 20 years, what's happened. This country lives on migration. They cannot do beyond that. They might be obviously balancing what type of people they want in the country and looking at that as an option. It could be very ancient thing what you've written there. That data is not wrong what you've said, but in my opinion, without migration, government is not getting the dollars, the foreign dollars that they need. Without students, they will not be able to pay their COVID tax that they have to pay. So it is not going to serve the government well if they sort of start to close on migration. I don't think this is the country of migration, has always been. So there's a lot that this country can give. There's a land of opportunities. People want to be here. With all that, Iran, Iraq, and all those wars that are happening, people don't want to live there, and people are shifting here. So the good thing is that Australia can make a choice which people they want in this country, as opposed to saying they're stopping migration. So that's really where the filtering is happening. Earlier, it was like if you have the pulse, you want to apply, go back 30, 40 years, you want to come to Australia, just come to Australia, you're welcome. Right now, they're putting criteria around it because they need to make sure they bring the right people into it. But I don't think they're slowing it down. They're just trying to make sure that they have the right people coming in this country. For that, they may be taking some corrective action. So that's my view on that. Next one, lots of pressure on government to help first-home buyers. There are talks about removing negative gearing or CGD. If that happens, what's the impact on property market? Good question, Hemi. So with the actual negative gearing conversation that are happening, which Greens have started and sort of putting pressure on Labour, back in 1980, they actually removed negative gearing as well. That's actually happened and didn't last very long, because the moment they remove negative gearing means that they actually telling investors don't invest, because a lot of people like negative gearing. Investors do that for negative gearing because they want tax back. If that happens, that basically means that renters are going to struggle in this country to rent out properties, because if there aren't any investors or not many investors, there aren't any rental properties available, which puts a lot of pressure on rents, and that would basically put a lot of pressure on renters to be able to rent or even get a property to rent, which again becomes the problem of the government, because they're not building enough anyway. So how are they going to solve the problem? So this whole negative gearing thing has also come up in the discussions about 3 or 4 years ago, when Labour lost that in as elections in Victoria. Liberal took over because they were going to remove negative gearing, and I believe that's why they lost it. Now Liberal took over, and then now Labour's back again because they said that we're going to again keep the negative gearing there. So look, political play is one part, but it does not play very well in the overall property market if they remove negative gearing, and that actually imbalance. It puts a lot of pressure on government back on to be able to support the tenants, and that's not going to work well. So they have seen it historically. I don't think a wise government would take that action. So this is probably a political play than anything else, but in reality, I don't think that's going to happen. It's been there for good 40 years, and it's here to stay. That's my opinion. So thank you. So I believe you liked the presentation. I loved your questions, although they were small. And Amy's got one more question. But what would that solve for housing market issues? The whole point is help for home buyer to get. Yes, I mean, home buyer, as I said, struggled 20 years ago, they're struggling now. All government can do is keep providing incentives. And I think there are state government, federal government incentives available for first home buyers. The problem is not first home buyer alone. The problem is not building enough. The construction is the issue. We have too many people in this country, but we don't have enough dwellings over here. So if they actually try to solve the supply issue the right way, I think they'll get a lead way up, and a lot of things come back into the ecosystem and start balancing itself. So the issue is the supply. It's nothing to do with the type of home buyer as a first home buyer, because let's say first home buyer, even today in Melbourne market, for example, a first home buyer can easily buy a property under $600,000, right? There are properties available. You can still buy townhouses under $600,000 and get all the incentives that you want. It's no stamp duty. You can get the benefit. You can go to South Australia. They have repealed the stamp duty right now, regardless of what the price point of the property is for first home buyers. So different states have got already enough incentives out there for first home buyers to go and step into it. During COVID, we also saw government was allowing superannuation to be withdrawn, so you can go get your home for yourself. So they'll keep doing this, and we've seen just too many schemes come through in the last 20 years. Myself, I've seen that happen. But when it comes to price points, they struggle. In fact, this is the window when most investors are sitting at home, on the fence, not buying properties. It is the first home buyer market, and that's what's actually we are seeing more in the market right now. A lot of first home buyers are out there because this is the sweet zone right now. The moment interest rates come down, investors are out again, and the first home buyers are going to struggle again to try and compete with investors with big pockets. All right. I hope I've answered all of that. We've gone a little bit over the time, but I hope you've enjoyed our first webinar through this group as well in I Love Property that we've posted. And I'll keep bringing more whatever we can do. But thank you so much for your attendance tonight, and have a great evening and talk soon. Cheers.